Hey everyone, we are Group 7.
Group 7 team members are Tai Wei Cheng, me Fatin, Fesana, and Muhammad Shawal. So for this presentation, we will talk about the introduction, financial analysis, non-financial analysis, recommendation for management, and lastly is the conclusion. So for the introduction, we will talk about the background of the company, and we are using the financial statements of Group BERHAD from the year 2022 to 2024.
Okay, we are going to the introduction. So Group BERHAD is formerly known as the Asia Media Group in BERHAD. The core business is a telecommunication in media. The business is a advertising business. So the major business is a comprising business in the multimedia advertising services and multimedia production. There are three subsidiaries under the Group BERHAD, which is owned 100% by Group BERHAD, which is the first company is Creative BERHAD, the second is Digital BERHAD, the third is Media BERHAD. So the profit shows it dropped to 209,319 ringgit in 2024. It's dropped from 96%. So by the 35 October 2019, it's classified as a TN17 company in the BURSA CQD.
Assalamualaikum and hi doctor. Next we will discuss on the financial analysis of Group BERHAD. My name is Fatin and I will discuss the profitability and liquidity analysis for the year 2024 as compared to 2023. Let's start with profitability where all the ratios declined sharply. Gross profit margin dropped from 54.37% to 31.93% mainly due to 39.6% falls in revenue, while the cost of goods sold only reduced slightly. This reflects that the company has a high fixed cost component such as depreciation and maintenance which didn't scale down with revenue. More critically, operating profit margin fell from a healthy 39.4% to negative 3.33%, showing that core operations are now running at loss. Administrative costs also stay almost flat despite the significant revenue drop, reflecting a rigid cost structure. The net profit margin also collapsed from 26.5% to just 2.82%, with the company only remain profitable due to the tax credit and not from its core operation. Return on asset fell from 21.98% to 1.17%, while return on equity dropped from 29.27% to 1.65% as the profit dropped significantly in 2024. This indicates that Group has poor asset utilization and effective capital return. Return on capital employed even turned negative in 2024, confirming that the recent digital investment are not producing sufficient return while the costs remain high due to the fixed cost component. Now on liquidity, the current and quick ratios both declined from 1.29 to 1.01 above the minimum threshold. This shows that Group BERHAD is barely covering its short-term liabilities with low cash reserve and heavy reliance on trade receivable. Although the operating cash flow to current liabilities improved to 0.26 in 2024, it still indicates that only 26% of the obligation are covered by operating cash. The improvement of the operating cash flow to current liability is due to change in working capital and reliance on non-cash items, not from the improvement of the operation.
Hi guys, my name is Wei Ching and I'll be continuing on the solvency ratio. So first, the debt to equity ratio actually has seen a slightly improvement from zero point 0.4 to 0.38. So this means that actually the company is relying less on its debt itself, but the change actually came from a tax credit that boosted their net profit, which actually does not show a stronger business performance. So it's not a solid win itself. Whereas next, their interest coverage ratio has dropped sharply from 65.79% to a negative 3.92, which is a big concern as revenue actually fell by almost 40%, right? But their admin cost actually stayed the same, causing an operation loss itself. So the company actually couldn't even cover its interest, which raises a red flag about financial risk. Whereas finally, the equity ratio actually increases slightly from 71.5% to a 72.4%, which actually tells us the company is still mainly funded by their equity, which sounds great, but then again, it's mainly because of that same tax credit itself. So in short, while the numbers seem better, they are not backed by real performance, so the improvement might not hold long up for the long term itself. Alright, so moving on to efficiency ratio, starting with operation ratio, it can be seen that it's increasing from 0.82 to 1.27, which actually tells us that the company actually spend more than it's earning, where their revenue is dropping more, but their admin cost did not change. So operation actually becomes less efficient itself. Whereas for payables turnover, it fell from 355 to 12. That's actually a good thing, which it tells us they are now paying suppliers monthly, which is more typical, and it suggests a better credit term or improved cash flow. Whereas for their receivable turnover, it also is dropping from a 9 to 4.5, which tells us they are actually collecting money much slower, which puts pressure on their cash flow. And this likely means that they are giving their customers more time to pay or face delays in collecting. Alright, whereas for the average collection period, it can be seen that it's doubled from 40 to 81 days, which tells us the company now takes a longer time to get paid, which is risky when their revenue is already falling. Lastly, their asset turnover actually is dropping from a 1.29 to 0.42, which tells us they are actually making less money from the same amount of assets. It slightly points to underused investments like LED panels that aren't bringing in the returns yet. So overall, the company becoming less efficient, which tells us they are slowing collecting and not fully using its resources to drive revenue. Alright, so for the cash trend itself, in 2023, the from operating activities was from 9K, which is showing a very weak sign, but by 2024, it actually increases to about 1 million. So this big leap wasn't actually from a stronger performance, though it was mostly due to tax credit and changes in working capital, like for instance, higher payables and delayed payments. So the improvement isn't really sustainable itself. Moving on to net cash used in investing activities itself, their investment spending has actually dropped nearly 90% by 2024 from 4.48 million to just 462,000 as the company actually paused their expansion to conserve cash. Whereas for their financing cash outflow, it can be seen that increasing, showing they are actually repaying their debt without taking new loans. It's actually a cautious move, but it may limit their future growth itself. So overall, while cash actually looks stronger on paper, it's clear the company is just tightening spending and holding back itself from not growing from real operational strength.
So, what is the red flag and the root cause that we can identify from the profitability and liquidity analysis? On the profitability side, the numbers are showing a downward trend, where the return on equity dropped to just 1.65%, indicating that the company is not delivering return to its shareholders. Even more concerning, the return on capital employed has turned negative, so the money they have invested into business isn't generating profit. A big part of the problems came down to the operational inefficiency. Revenue dropped by 39.6% due to fewer contract and end of programmatic advertising. However, the company still has a large fixed cost component such as depreciation, maintenance, and administrative expenses. The drop in revenue is not aligned with the cost. Now we look at liquidity, it is also a similar story. The current and quick ratio are just above the safety line, but they have fallen year to year, signifying a growing pressure on the short-term finances. Cash reserves are really low, which is around 331,000, while the company is heavily relying on trade receivable, which make the cash flow timing more risky. At the same time, the operating cash flow is very weak as they are carrying more current liabilities, mostly from unpaid suppliers. Even though the depreciation is cushioning the reported loss, it doesn't fit the core issue where MM Group BERHAD isn't generating enough cash from its operation.
Hey guys, I'm going to continue from here. So here's what stood out on the solvency side. Increased coverage has actually dropped hard into the negative, while their actually D&E equity ratio looked better. It was mostly due to their credit tax and not their actual business performance. Whereas for their efficiency side, all the key ratios has weakened. Cost was actually higher than their revenue, whereas their collection period has slowed down and their assets weren't actually fully used. So what's really happening to their revenue is that they took a big hit on their costs, which didn't adjust far enough, and their assets they invested in just aren't enough generating the returns for them. Lastly, for the cash flow category from operations itself, it has jumped from a 9K to 1 million, but it wasn't actually due to a stronger performance, just timing and non-cash items itself. So overall, right, that's the red flag. While the numbers improve on paper, the root causes show operations are still weak and not driving real growth for them.
Good day everyone, I'm Prasanna Kaliselvan here to explain about the non-financial analyst. So let's go to the topic. non-financial indicator. Even though the report doesn't explain much about the non-financial information, we still can identify few issues. So one of the problem is the change in advertising industry. Programmatic advertising was stopped and there are fewer advertising contracts. So this shows that companies' old business model is no longer working in today's market. And followingly, another problem was the company spent a lot of money in digital advertising equipment, also known as DOOH, which is digital out of home. Like LED screen, however, these assets are not being used enough in our costing. It needs a lot of maintenance and depreciations. So far, they have not brought enough income to make the investment worthwhile. And finally, despite spending a lot, the company result is still poor. This may show the weak leadership and poor planning and also bad execution in strategy. There may also be problem with how the company control its spending and manage the staff and also collect the money from the customer. All these minor issues should be highlighted to MMM Group to recover their tough time. So the next part would be the strategic diagnosis using the managerial tools. For this, we have used two tools, which is SWOT analysis and also the Porter 5 forces analysis. So when it's come to SWOT analysis, MMM Group BERHAD was a few strengths it can build on even though the company is financial trouble. One of the main strengths is existing digital out of home, which is DOOH, infrastructure, which is include LED screen and other advertising equipment. Another small positive in 2024, the company showed some improvement in managing its cash, mainly adjusting how to handle the payments and collection, although it is not in a longer term solution. However, the company has several serious weaknesses. It suffers from the operational inefficiencies. Managing it spends more than it earns to run its business. The company has high level of fixed costs such as salary, equipment maintenance, and office expenses, which do not reduce even its income drops. Its invest, especially in digital advertising equipment, have not brought in enough profit, leading to a poor returns. It also has negative profit margin and struggle to collect payment from the customer on time, which affect the cash flow as well. Additionally, it also not using its asset effectively, as seen in the lowest asset turnover. Despite these problems, there are still some opportunities that company can explore. As the economy recovers, there may a growing demand for modern and creative digital advertising solution. MMM Group could take advantage of this trend and improve its service and target the right customer. There may also be a chance from the partnership with other companies to share the advertising platform to reduce the cost. At the same time, MMM Groups face several threats such as the digital media world is changing quickly. So new technologies and platform emerging often. Competitors with more flexible and update their business models might gain market share faster. Lastly, there is a low demand for traditional form of advertising which affect the MMM Group older business model. If the company does not adapt quickly, it may fall further behind. The next analysis would be the Porter's 5 force analysis. So first of all, the threat of new entrants. So the threat of new entrants into a digital advertising and media space is moderate, while the digital out of home, which is DOOH advertising market, requires high initial investment in technology such as LED panels, projector to create a barrier to entry. Smaller, agile competitor with digital capabilities and minimal physical infrastructure can still penetrate the market. MMM Group, large capital investment in fixed digital infrastructure have not resulted the proportional returns, which suggests that new entrants with asset-light and tech-driven models could easily undercut them. Furthermore, MMM's declining financial performance may signal a weakening market position, reducing its ability to deter the new competitor. Followingly, bargaining power of supplier. Supplier holding a significant power in MMM's business model. This company depend on the high cost and specialized technology proven for its LED screen, uplift the project and digital display equipments. These assets are required to continue maintenance and incur higher depreciation costs, which are evident for the company's fixed cost structure. So the financial report also shows the increase of trade payable and heavy reliance on non-cash adjustment, hinting that MMM may delaying the supplier's payment due to cash flow constraints. This depends give the supplier leverage in setting the price and term, which add more pressure on the company which is already strained margin. So the third part would be the bargaining power of customer. Customer of MMM group wield high bargaining power, primarily due to the availability of alternative advertising platform. With digital and social media marketing growing rapidly, client can easily switch to more cost-effective and flexible advertising channel. This is particularly concerning MMM as their financial data reflects a sharp drop in revenue and extended average collection period from 18 to 40 to 81 days indicate the difficulties in client to retention the payment collection. These symptoms point to declining the customer's loyalty and increasing the price sensitivity, which undermine the company's ability to maintain the stable revenue streams. Fourth part would be the traits of substitute. That the trait of substitutes is high in advertising and media industry. As the advertising shift towards the digital and social platform like Google advertisement, Facebook, TikTok, and influencer marketing channels that offers targeted outreach to real-time analytics, the appeal of statistic or even the digital outdoor advertisement weakens. MMM's heavy investment in physical digital display may not able to align with enough to compete with the alternatives. Moreover, the end of problematic advertisement in 2024, as a note of the report, removed the potential of growth avenue and further export the companies to the substitution risk. Finally, industry rivalry. So, industry rivalry is intense. The advertising sector, especially digital marketing and outdoor advertising, is saturated with both traditional and modern competitors. MMM's steps revenue decline of 39.6% and negative operating margin indicates that they're struggling to maintain the market share. Additionally, fixed costs rigidly and underutilized digital assets, such as inefficient in comparison to competitors who may be operating with leaner models. The combination of declining profitability and reducing asset turnover and also strategic missteps such as poor return on capital puts the MMM at a disadvantage in a highly competitive market landscape.
Okay, we are going to the recommendation. There are several recommendations based on the both financial and non-financial, which is to help improve the company performance. The first is a financial re-engineering to improve the financial performance. The second is governance improvement, is to improve risk management. The third is operating restructuring, is streamline processes to improve the overall performance. The fourth is innovation strategy. It strengthen a long-term competitive with a strategic partner. This is innovation strategy is from the partnership with the technology firm can support the integration of the advanced capabilities such as the automate ad scaling, campaign performance analytics, and the remote content control without the requiring internal system development. Okay, we go to the last is of question. So currently, MMN Group BERHAD is restructuring plan under PN17. So the next is the detail of the financial and non-financial analysis conduct to the reveal company financial distress. So next is by using the strategic management tool like SWOT for the five forces, highlighted the company competitive and rapidly for advertising industry. So next is on this report, some practical recommendations to address the challenges. So the last is most of the important to the turnover strategy under PN17 is demonstrate all the strength of the company to avoid the potential delisting from the BURSA security. So that's all from our group number 7. Thank you.